We had our first sell-off, our first loss of the week today, and it ended up being a half a point loss. So we are at resistance. We are resistance that pretty much everybody in the world is expecting us to approach. With small ranges and small volume, we're getting typical patterns for trading in this death cross environment this far below the 200-day moving average. So now what? Now what do we expect to see in the next couple of weeks? I'm going to break that down in depth here today with this weekend video. We're also going to take a look at, from a sector rotation standpoint, how that's performing with a trade idea here in an area that's in a sector that we would expect to continue to be weak, even with a sustained, with a bounce, with a recovery. So let's go ahead and get started. Today is Friday, January the 11th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the Market Forecast Indicator, like we always do. First down day that we had in after 5 straight up days. And if you look at it, we had, 9 out of 11 up days coming off that Christmas Eve low point. And the only loss of the week ended up being, less than a point on SPX. Let's see, let's go back to SPX here. Less than a point, less than half a point on SPX by the time it was all said and done. So you notice we have turned dark green on this chart, which means the intermediate line has turned up above 50 now. That typically starts that 1 to 3 month pattern. Now, we've seen this a couple of times already. What we're missing still is that dark green line on the moving average. See, the moving average now is still yellow, which means we're above a falling moving average. We need to be above a rising moving average, which is what will turn it green. And that combination is what starts that 1 to 3 month expected return that we didn't have. We had for one day there that was immediately turned down the very next day. So, and also too, keep in mind that when the intermediate line runs up to 50 from the lower reversal zone, typically there's a hiccup, right? Typically we get some kind of a short-term pullback that will then lead to more of a bullish run. And so that's the expectation here, that we will get some kind of short-term weakness down to 2,500, maybe even to 2,450. Maybe even to 2,400. I mean, depending upon what causes the weakness and what headlines we get. In the past, when we've come off such extreme lows below the 200-day moving average, we tend to retest them, if not come a little bit below them. Now, I don't think we'll get too far below this one because of how extremely low this was, but we can get to 2,400 with much higher lows on the oscillators themselves, because these lows in the oscillators, these indicators down here, was so extreme. I mean, look at all these multiple consecutive oversold clusters. It's very rare to get that many. So that was an extreme low. I would venture to guess it'll be very unlikely, not 0%, but very unlikely we'll get to lower lows. Most likely get the higher lows, but the intermediate line most likely won't even form another cluster on the next low point. So we'll keep an eye on where it does. You can see this falling trend line that we bust up there a little bit, but the reality is we're kind of hitting up against that. We're hitting up against the 50-day moving average. You'll see here in a second. So there's some resistance. You can see even here, this 2,600 was an important level. We touched on an intraday basis. We were there here in December before the FOMC meeting, and the FOMC meeting, you can see, is what pushed us through to the downside over here. So that broke us through 2,600 right before the FOMC meeting. That will break down on the first oversold cluster there. So just like that, though, we recovered all those losses. So this kind of shows how bearish we actually were, how bearish we were that produced all those clusters. We have reversed all those days, all the losses of those days, of all those clusters. You can see a very similar pattern on all of the major indexes. The Dow's not quite above 50 yet, but it's pretty much there. The NASDAQ is a little bit further up above 50. This is the second day it's been dark green, but still has only a yellow moving average. And then the Russell 2000 is also now above 50. Strong short-term sentiment with all of these. And a reminder, too, that the near-term runs don't last as long when the intermediate line is coming up from lower levels, right? You get the typical 7 to 12 day near-term runs, the blue line, up above 50 when you got a strong bullish posture. We were coming up off a very weak bullish posture. We had a short run there. We would expect a short run here. We've already got 5 days up above 50. In fact, we got 5 days up above 80. And so the idea being that wouldn't be surprising if we get short-term weakness that brings us down, and we have, we've already had 5. It's 3 to 5 days is what we expect, so we already have 5. So we're actually already pretty good. We most likely, because of how high we are, will probably get 6 or 7 at least on this near-term run. But I doubt we'll get like the 12 or more, which is generally the case on that first near-term rally when the near-term line makes its way up above the chart's midpoint and starts that 1 to 3 month expectation. Usually that first near-term rally has a pretty decent run, has a good near-term run. You can see this intermediate line was not coming from the reversal zone, so when it turned up, its near-term line stayed up above 50 for quite a while, for a few weeks, before we got that short near-term weakness there. Before we look at some other charts, a reminder to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your video, then click that red subscribe button that pops out. That will notify you when these videos are posted, so that you're aware of that. Also, click the thumbs up icon down below the video. That tells me, number one, that you got something out of it. Number two, that you want us to do the video again on Monday. Really easy way to give us feedback in one click. You can do that right now while you're watching. Scroll down further below and comment on something you got out of the video today. Anything that you learned, or any interesting tidbit, or whether even if you have a question or comment on anything that we talked about in the video, comment down below. We'd love to see your thoughts there. Join our daily Market Outlook email list. There's a link popping out in the top right corner of your screen. Click that link to subscribe. Follow me on Twitter for more content like this throughout the day in between videos. And then finally, join our Market Outlook community that we created over on Facebook. Now, another way to give us really quick and easy feedback is here on our blog. If you're watching the video here, scroll below the video. You can do that right now while you're watching. 3 clicks. Number one, click on this heart. That will open up a new window where you can like today's Market Outlook tweet on Twitter. Click that like button. Here, click this Market Outlook. That will open up a new window where you can like today's Facebook post, Market Outlook Facebook post. Again, if you click on those things, it helps us because it promotes the video to these platforms, suggests it's content that they should share with people who follow us. And then secondly, it tells them that you want Twitter and Facebook to keep sharing our stuff. Because timelines get crowded, right? So they want to share with you what you engage with. So the more you engage with our Market Outlook and anything that we post, Brandon or I, the more Twitter and Facebook will keep sharing you the stuff that we put out there. Finally, you can click this button right here that will like the video here on our blog. Other couple things here on the page to remind you of. Here's our class schedule. If you want to see more, just click that View More button. That will take you to our calendar. You can also subscribe to our site for free by clicking on this image here. Opens up a new window. If you subscribe to our site for free, you can participate in our forum, in our Market Outlook forum, with other market scholars, to be able to ask questions, comment, share ideas with people who watch this video like you. Just click that link to get to that particular forum. Alright, back to the chart. So now you'll see here on the long-term chart that we have hit in 3 weeks. It's taken 3 weeks to overcome the Christmas Eve week, right? The really down Christmas Eve week. Well, actually, it would have been the week before Christmas Eve. Christmas Eve was the low point on that week. So the week, the FOMC week, I guess would be a better way of saying that one. And it was also options expiration there in December. But how bad of a week we had there that dropped us all the way down to this 50% Fibonacci retracement coming out of the FOMC. We were at the 38% before, but it's taken 3 weeks now to recover all those losses. But you can see it's a pretty decent recovery. I mean, that was a pretty steep drop. All the selling was okay before that week because we were still up above these lows. Things were fine. It was that 1 week that kind of, where the dam broke, so to speak. Well, now we've recovered that. Now, typically, when we get this far below the 200-day moving average, typically we'll make a return. We'll bounce sharply. We'll get a V bottom like this, but we'll get it. But we typically hit that 50-day moving average, which is the orange line. And then we will get some short-term weakness and potentially even come back down into this area. Especially now, granted, because we are so far below the 50, which is pretty rare, we did get really far below. You can see some of these other areas we didn't get so far. Last time we got the death cross, we didn't get so far below there. If you look at some of these other instances of death crosses here recently, and here let's put it on a logarithmic chart so we can compare over the long term at different prices. So log scale right there. Alright, so if I were to look at other instances of death crosses, again, you can see we didn't get too far below the 50-day moving average there. You can kind of see the difference here. If you go back to 2010, same thing. We didn't get below the too far, and the same thing in 2008. You know, if this ends up turning into a bear market, see, this was not a bear market move. It was a steep sell-off, but it wasn't a bear market. This is a bear market. You know, multiple months of a death cross that we don't recover from after making a failed return move to the 200. So, you know, but you see, before we make that return move to the 200, we typically make a move quickly to the 50-day before we retest, if not go to lower lows, and then we make the return move. This was early 2008. If we are headed into a bear market, this is the stage that we're in right now. The last time we had that 2008. So right now we're at the stage where we hit the 50. Now in these other instances, 2008, 2011 we didn't quite hit a low. We hit a higher low point. 2010, excuse me. 2011 we did get to a lower low. 2015 and 16 we also did get to lower lows in both of these cases. But again, we weren't so far below the 50. This is the furthest away in all those examples that we got away from the 50. Because of that, I would not expect us to get to a lower low. I do expect that we'll come down towards this area, 2,500, 2,450. Because again, you remember, if you look at, you know, if you think, okay, well, there's some, this was a really fluffy move. Before the FOMC meeting here, right after the FOMC meeting, we did drop to 2,500. That's where we hit. And then we had, you know, 2 days to finish the week and Christmas Eve, where we just really, you know, kind of capitulated. And in, you know, 2 days, we recovered all those losses back to 2,500. So that's why I'm like, okay, 2,500 seems to be the real kind of true area that we probably should have stopped selling off at because of how it reacted once we got below it and back up above it. So again, that's where I think we might get, if the low was set there, we could get a low point down to 2,450 again. And that would have been a lower low, but considering the capitulation move that made such an extreme, that, you know, we'll probably, you know, that now we'll probably get a higher low point on this next little short-term weakness. Again, in that 2,450 to 2,500. Then you'll make a return move to the 200-day moving average, which right now is at 2,700, the blue line. But by then, it might be at 2,600, 2,650 by the time, because it's going to keep falling as we fall in the short term. Remember, you've also got this Fibonacci retracement zone that's also right around 2,500. So that's going to act as a support level as we head down. This little congestion area too, also right around a little bit below 2,500, down to 2,450 or 24 and a quarter. So that little congestion area where there's some volume, that's kind of the next area, strong volume on the chart, especially now with all this extra volume that we've had in the area. That's where there's going to be that layer of support if we pull back even further. Alright, now let's take a look at the 3 green arrows chart. Of course, we have 3 green arrows. Again, we've seen this before. We don't have the green line yet. We need the 3 green arrows with the green line to really say, okay, we are entrenched now in this bullish zone. If you take a look at the 2-line versions of these indicators, you can see the 8 days crossed the 17, but we're still so far below the 30 that neither one of them are crossing the 30. That's, Usually you want to see, usually you get the crossover the 8 over the 17 at about the same time it crosses the 30, similar to this over here, and that's not the case yet. And when you get that, that usually implies a retest. When you get that cross above the 17, but neither are close to crossing a falling 30, so you tend to get a retest. And when you come off extreme lows on the MACD towards the midpoint, similar to the intermediate line, you tend to get a hiccup, right? You tend to come back down and form a new low point, similar to this over here. So that's the expectations going into this next couple of weeks. Keep in mind, too, seasonally, January is not a good time of year for stocks. Stocks tend to be more bearish in January. Again, seasonality is not 100% as we learned in 2018, but it doesn't mean one unexpected move, unseasonal move doesn't mean that seasonality is that we just throw it out the window, right? We still have to pay attention to it. And if you look at the 20-year period, and then put this as a percentage here, you can see January into early February tends to be a weak period, regardless. So we've had a good start to January, similar to what we saw last year. But when we pull away from the average moves, we tend to come back down to it, and that's again another reason to expect short-term weakness. All right, now let's look at the intraday chart, and you can see how we've really started to taper off again, which is a typical pattern when you're heading into resistance areas to tend to get smaller moves, lower volume. Look at the volume tapering off too down here below. In fact, if you take a look at today's volume and trading range, 2-point trading range, no gap, so you don't have to factor that in. Less than 74 million shares trading hands. Go back to this chart here really quick. Today's range fit at the upper end of yesterday's range, which is also pretty small. You can see that the high point is going to start falling down. Eventually it will get down to current levels. You see that they'll hit this high point here over the next week, which is also about where we're at right now. So you could say in the next couple of weeks that we are currently trading at the 4-week high point. That midpoint, which is at 250, which will act as a support, 2,500 on the S&P, will most likely make its way down towards this 245 area, 2,450. So that, again, another reason to expect some support in this area as we do pull back. Because that's where we can still move lower and stay in the upper half of the range. The stochastics can stay bullish because of that, because the high point will be moving lower and the low point will still stay. In fact, this tag for the high point will get to the left, to the right of the low point, which is bullish. It's bearish to have it to the left of it. It's bullish to have the high point to the right of it. So that's a good sign, and the sign again that we're trading near the high of the 4-week range. And it suggests again that we can pull back easily, and it wouldn't be a bad thing. It wouldn't be really a bearish thing that will pull back, because we would still easily be in the upper half of the range. All right, let's take a look at that volume again in context here. 74 million shares trading hands right here is way below the average, towards the lower end, in fact towards the 52-week low for that average. The trading range of 2 points also well below the average. Again, towards the 52-week low for that average. And of course, 2 points is below 1%, which is also that bullish zone, right? When you get below 1% on the average, then that's bullish, right? That's when your bullish trend is entrenched. And you notice, though, that these lines do fall for a while, though, as I mentioned before the intermediate trend starts, as we've seen in the past. So we just barely started the fall. Again, we will probably get more of a pullback. The averages are still very high, that we don't have to have big moves to the downside to keep these things falling, even with the pullback. See it as we fell back down and retested lows here. These lines were still falling because they weren't that big of a down days, right? Not nearly as big as these down days were that made the lines go up. So when you get that next retest, that next retest usually doesn't mean that we'll get, especially because these highs are so big on the first go around, the next retest will have smaller moves to the downside than the original, and so it'll be slower and it'll be less bearish because of that. And that's a sign that would tell us that it's just that, just a retest. All right, finally, let's look at the volatility, and you can see we did break the 95% level on the relative volatility, the VIX to the 3-month VIX, but even then, the 90% can still act as a support level, and I would still expect it to. We're still above 15. We need to kind of get below that 15 area and get below, especially get below 90%. To really get this bullish trend entrenched. So expect, support to hold in this neutral zone as we've seen before, and make a run back towards 1, and make a run back towards 20, maybe a little bit above 20, on a retest of these lows as we pull back in the short term. Then once we break 90, then once we get towards 15, if not through it, as you've seen here, if I go back to back in this area, when that bullish trend and trend, we finally broke below 90%. We broke below 15. Yeah, we had a couple of jumps in the short term up there, but not long lasting like we had before the bullish trend got entrenched. And then then we were bullish for multiple months, right? Then that long term run started. So to summarize, we've had a nice good bounce over the last couple of weeks. 10% move off of an extreme low below the 200-day moving average. It's a very, very typical move when we're this far below the 200-day moving average. We are slowly moving towards resistance with the smaller ranges and less volume. This pattern we've seen a lot of times in the past, and would suggest that in the short term, next maybe a couple of weeks, especially with the seasonality factored in, that we can expect some weakness. We've got plenty of room to go down without getting bearish, right? To be just a near-term pullback Fibonacci retracement of this 10% rally that we've had. Then we'll get that low point where we'll get that return move back to the 200-day moving average, which will tell us, is this, we're going to get a golden cross and start a new long-term run, or are we going to fail like we did in early 2008 and start a bear market at that point, which would, cause us to make some serious adjustments to portfolios, because we can be in this death cross environment for multiple months going forward, as we saw then. So, and as we saw in early 2001 as well. So that's our take for now. Now the expectation is that we won't. The expectation is we'll get that golden cross because of the macro environment that we're in. But of course anything can happen, so we need to be aware of the possibility of that failed move at the 200-day moving average. But we're not there yet, right? We're in the mode right now where before we get the return move back to that long-term line, we'll get a short-term retest of those extreme lows, at least near those extreme lows. And that's the mode that we're in probably for the next week or two. So what do you think? Do you agree with that or disagree? There's a link popping out in the top right corner of your screen. Click on that link, then either hit agree or disagree. If you click disagree, scroll down below. You can comment on what you see that would suggest otherwise. Maybe we'll get that golden cross right now and you see more bullish signs that we didn't show. Or maybe you think that next retest of lows will be the 2008 fall off the cliff, and we just happen to get it early in the bear market instead of late, as we see in other bear markets. So let me know down there below what you're seeing that you'd like to share with other market scholars as well. All right, now let's take a look here briefly at what's driving the action today. There wasn't actually too much here on the economic calendar today. Over here you can see CPI was really the main thing that came out. Of course, inflation's an important number. Everybody's kind of paying some focus to it. You can see the year-over-year inflation numbers fell from 2.2% to 1.1%. Now, on the core basis, it stayed flat. So you can see here's the year-over-year figures. And the core has been flat this whole time, while the headline figure, which had approached 3%, has gradually moved back below 2%. So again, another reason, while the core is flat, see over here it stayed flat while we were rising, now we're falling. Another reason for the Fed really to keep interest rates steady. Of course, at the next meeting in January, the next really meeting where they have their press conference is in March. Almost 100% odds we won't get any move at all, up or down. by the end of the year, that's kind of where people are watching to see, because that's the Fed in March will also issue their dot plots, which from December still say that there's going to be 2 rate hikes in 2019. Well, there's only a 15% chance we'll only get one. So very, very low odds we'll get even one hike in 2019. In fact, we almost have the same odds that we'll get a rate cut in 2019. So the things will change, and that's the market will be watching, not in January, because January you'll just get a statement, and we'll see if the statement gets more dovish itself. But March is when they'll issue their updated projections and forecasts, as well as the press conference, which Fed Chair Powell didn't do so good with last time. But we'll see, that will really start to move the markets again, at least these futures markets, on the Fed funds rate. GDP levels or expectations are still relatively high based on yesterday's updated, still at 2.8% for Q4. This will be updated next on Wednesday with retail sales coming out. Let's see here, where's the calendar again? Right here. Let's go back to next week. It'll be the 16th is when the next time it will be updated. So not a whole lot on the calendar Monday or Tuesday, Empire State Manufacturing and PPI on Tuesday, but Wednesday is when we get a lot of different indicators, as well as the beige book, which is the data that they'll be looking at heading into the January meeting, the FOMC meeting for January. So big week towards the end of the week. Starts on Tuesday with a couple of things. A lot of Fed speakers too coming out. Kashkari in particular over a couple of days. We'll see. He's been pretty dovish in the past. We'll see if that ends up being the case. And then you have Williams here finishing the week. So you got a few speakers, especially on Tuesday. Nothing really on Monday. So expect another day like today. Small range, sitting at resistance, very low volume. Then we'll probably start to get some movement with some headlines coming through. Remember, we're also starting earnings season. So that will also provide some headlines for markets to move. At least from a technical perspective to the downside. Of course, anything can happen. We can continue to move to the upside, but we'll start to get some pickup in those movements by the middle of next week. Here's how the different asset classes performed over the last couple of weeks. So this is the last 10 days, right? So if we go, and let's get to the 10 days on the open. So here's the 12th. We'll go to the open on December the 31st. There we go, and we'll go to a 10-minute chart. So there's our last 2 weeks move. Crude oil, which had been so bearish, has really changed direction. It's up 14% over the last couple of weeks. Small cap stocks, which in a good sign is really taken off versus large cap stocks. So an 8% move there. There's your developed markets and international markets, both lagging behind the S&P, even with a weaker dollar. But here over the last week or so from the start of this week, if I were to move this forward to here just this week, there's the emerging markets have actually kept pace with the S&P, if not outperformed it a little bit for most of the week. Developed markets still lagging behind there. High yield also bouncing. There's a lot of chatter about that being where the bubble will burst, as in the high yield debt market. Preferred stocks also closing the week strong. Debt, long treasuries and were down this week. Not as much, but down this week, and the dollar was also down. Gold lagged behind, crude oil especially, but lagged behind stocks too, but was up because of the weakness in the dollar. And if you take a look at the dollar, that's it's had a really negative last couple of weeks, which is actually pretty bullish for stocks. To see some weakness. You can see when we had that strong 2017 into early 18, the dollar was really weak. And so that helps propel stocks forward usually. Usually propels international stocks more. So we'll keep our eyes in that area as we approach the next level. But remember, we are hitting that 200-day moving average. There's some short-term support. There's a gap at the 50 and the 200. So the dollar could find some short-term support here while the S&P experiences, from a technical perspective again, some short-term weakness. All right, from a sector rotation standpoint, this is the week that we've been on, the S&P up here. You can see all your bullish areas. Real estate's also had a good run. That's usually a laggard in this type of environment, but it had a good run here. Industrials, taking advantage of the weak dollar. Energy also with a strong move in Crude oil, technology, and discretionary typically outperform when we're coming off of deep lows. You can see healthcare materials lagging a little bit. Financials really lagging. Financials do, if this is the late stages of the economic cycle, business cycle, that's not a good environment for financials. So I wouldn't put a whole lot of stock into those and shift more eventually towards materials and energy, as those two have had the worst year. They've got the more potential going forward from the sell-off that we had. They had the much bigger losses during the sell-off, along with industrials. You can see typically staples and utilities. They had a positive week, just not as much. But remember, again, and if you go back to October the 3rd, so if you include the sell-off and the subsequent bounce, here's October the 3rd. And here, let's change that time frame to so we don't get so many data points here. So again, if you include from the sell-off and the subsequent bounce, they're still your outperformers. They hold their value better during these pullbacks, and yeah, they lag behind during the bounces, but these areas fell the most. You can see energy was down 30%, technology was down 24%, industrials was down 24%. A few others were down close to 20%. So they've got the most to bounce, right? And these are still utilities, in fact, have a gain throughout the whole process. So that's why, as the markets get more bullish, the idea is to shift more towards these safe haven areas because they will hold their value. In fact, if you take a look here, if you go back to say September, like even mid-August, so you had this little, we got pretty decently far away. So let's go towards the end of August, beginning of September on that sector chart. So the sector comparison on the 1-year chart. Then you can see, okay, well, let's go back here to, let's just go to September the 1st. Let's go to the 3rd here, Labor Day, Tuesday after Labor Day. And then to now, and then we'll go over like a daily chart here. Then you can see again, so they lagged behind as we were rallying, but the markets were pretty mature at that point. We had another month to go before we fell. So again, you can see as we shift into these safe haven areas, as the markets get more maturely bullish, then when you get the pullback and the subsequent bounces, they will still hold their value better. Even healthcare, because it was so bullish also during the drop. Healthcare also. So they're down 4 to 5%. Utilities flat over the whole period, where the S&P itself, the broad market, is down 10.5. So you cut your losses in half if we shift more towards those areas as we get more maturely bullish. So right now we're obviously not maturely bullish, so you'd want to stay more in cyclical areas, especially with the falling dollar, eventually towards industrials and energy materials. But as we bounce off of here, all your cyclical areas, especially technology and discretionary, tend to do well in this environment until we get that renewed golden cross on the long-term charts. We do have earnings coming out next week, and one stock that has earnings coming up here is JP Morgan. You can see the little tags. I've got that sticker in the way, so you can't really see the date that we have here. But it's, what do we have, 10-12 there? There we go, 115. So we're looking at, Tuesday for JP Morgan for that. Now you notice JP Morgan we had this bullish move. We hit support there. We fell below it, hit the 162% Fibonacci retracement, and then back up towards resistance. Remember, we expect short-term weakness from a technical perspective for the broad market. Financials in particular are weak because of the stage of the economic cycle. This is the move we've had heading into earnings. It's been very bearish heading into earnings. Even if we just get a knee-jerk reaction to the downside, there's opportunity to take advantage of the weakness, the resistance that we're hitting up here, and the expectation for weakness in the short term. So there's a way we can trade this. Obviously, it's a more aggressive trade if we were to do a bearish vertical here with a 50 delta at 105. That actually allows us a couple things, because the volatility of the earnings announcement suggests that we need to take into account of that. So by going for the higher deltas actually reduces my loss. So $303 Typically, we're shooting for a $116 gain, which is a $392 loss. So we reduce our loss from 400 down to 300 by being a little bit more aggressive. It also allows us to lose $197 because we don't want to lose 300, right? We want to position size around 100, or we want to position size around 300, but get out at 197. You can see at 197 on the purple line, we'd have to really move to the upside to be able to do that. So it gives us wiggle room, right? We got a lot of move with this volatility that we have, ramping up the premiums heading into the earnings. We've got a lot of wiggle room to the upside, and of course, as we set up the trade, if we typically position size on a normal trade without the extra risks involved of like an earnings announcement, if we do a 1%, we'd do probably 3 contracts here, and because that would, if a 1%, if it's $1,000 out of 100,000, then you'd do 3 contracts, position size normally. In this case, because of the extra risk, we'd probably position size smaller than that and only do a couple of contracts. So now my worst case scenario is only $600, which is much smaller than my normal risk that I use in a normal trade in this example. And then, of course, I'd be going for $400. I'd try to keep my loss to $400 if we do a bounce up. But again, with all this, the environments, the situations that we have looking forward, and because of the extra premium we're getting, we got a lot of wiggle room before we even get to a potential $400 loss. And again, we'd only be shooting for that 50% gain, right? So we'd only need to get to about in this area, down to 95, down in this. So even if we just get a knee-jerk reaction move, and you can see earnings to typically produce relatively big ranges, if not big gaps. We tend to get bigger ranges after earnings on all of these. See how big the ranges are? So we got the possibility that we can produce a move. And again, the trend, the technical perspective from an individual basis up to a macro level would suggest that if I had to guess which way it could go, it would be to the downside. But, never know what can happen. That's why we have to set stop orders and position size for the worst case scenario if it does what we don't expect it to do. All right, so that wraps us up for today. Now I want to hear from you. So use that link that's popping out in the top right corner of your video, or the link that's above the video in your blog. Let's go to the forums. Let's continue the interaction with other market scholars as well as myself and Brandon there, and post any questions or comments you have on the video on anything we discussed or anything we didn't discuss that you want to hear from other people, what their takes on. Remember to do that. Thank you very much for watching our video today. Subscribe to our YouTube channel, click that thumbs up icon, and comment. Also remember to follow us on Twitter for more content in between videos, and join our community on Facebook, as well as subscribe to our Market Scholars website. Thanks again. Have a great rest of your weekend, everybody, and we'll see you all next time.